Welcome everybody to our Tactical Tuesday this week. We have a really cool topic that I think a lot of you are going to find interesting. We're going to be comparing a lot of numbers. You can see behind me the whiteboard there. We're going to be using that. And we're going to be looking at different types of investments. So it should be a cool week for us, our Tactical Tuesday. And of course, as usual, we have the opportunity to answer whatever questions you might have. So if you have any questions, throw them in the feed. And I have my trusty assistant slash boss standing next to me here. That's Tiffany. And she's here. She's kind of watching the comments and everything. So, so if I miss anything, then she can let me know. All right, guys. So a really cool topic this week. It is real estate versus other typical type of investments. Who of you here before getting into the real estate investment world was kind of stuck on just a couple of options to invest in? You know, I think back to when I was a kid, and one of the first things my parents did is they opened a savings account for me. And that was what I thought, you know, not necessarily investing, but that was how you made money. And I remember seeing in my bank account a few pennies that I made, maybe a couple of dollars worth of interest that I would make in a month. And that was really, really exciting. And that was in a savings account. But what type of investments are we going to look at today? You see it on the board there, fixed income type investments. So like bonds, that sort of thing, where you have a fixed return, mutual funds, stocks, and of course, then we're going to talk about real estate and how that fits into this whole mold. So before we get started, say hi as you're coming on, guys. I can see a lot of the comments already from Halifax and from, I know Todd and Linda are out in the Vancouver area, and all over Megan from the Okanagan. So great to have you guys from all across Canada. That's awesome. So a couple caveats I want to put in for our training tonight. We're going to be running over numbers. We're going to be doing it back there on the whiteboard. But when we're talking about our numbers today, now there's obviously extremes to everything. We're going to be talking averages. So we're kind of taking what are the averages that happen out there when it comes to a fixed income investment, for example. What kind of averages are there out there when we're comparing that to real estate or to stocks, that sort of thing. So, you know, if you're sitting there and we're going through these numbers and you're saying, well, I got more than that on my stocks, or I didn't quite get that much when I was investing in stocks, just remember, we're just picking industry average type things, and you can do better or worse on any type of the investments that we're going to be talking about today. Okay, so I wanted to put that caveat in to begin with. And obviously, we're going to be making some assumptions today too. We're going to be comparing these investments with just a round number of $100,000. So if you have $100,000 to invest, how do each of these avenues, how do they work for you, kind of thing? I didn't mention New Brunswick. You're right, Ryan. Welcome from New Brunswick. I didn't see it, but thank you for making it a comment and putting it in bold letters so I can, there's no way I can miss that now. And Tiffany put it on the screen, which is awesome. So welcome for all of our peeps out in the New Brunswick and Atlantic Canada area. I know we have lots that are joining us from out there, so that's awesome. Okay, so should we get started? Sure. Why not? Remember those caveats, guys. Oh, and one other thing before we get started, if you are watching this on YouTube, come and join us in our Fearless Real Estate Facebook group. Just search Fearless Real Estate Investors. You will find us. You'll be able to network with so many other like-minded investors all across Canada. So I wanted to put that out to you if you are watching this on YouTube. And if you are already in our Fearless group, then just a reminder, every single Friday, I know you're here live with us on Tuesday nights, but every single Friday, we also put out short YouTube videos that have everything to do with real estate investment and raising capital and finding joint venture partners, all that kind of stuff. So make sure to subscribe to us on our YouTube channel, Investor Life. Just look that up. Okay, here we go, guys. Welcome to our Tactical Tuesday. We are comparing investments, different types of investments, and really the main ones that people look to or think of when they are wanting to invest their money. So let's start. Okay, here we go. We're going to start with our what we call a fixed income investment. Now, what is a fixed income investment? Well, that's one that typically is like a bond, a government bond. Maybe it's a corporate bond. It's something that is pretty secure, you can say. It's not nothing is guaranteed in life, but if you're going to have an investment that's close to a guarantee as far as an interest rate is concerned, this would be it. So really low risk, because why? These types of investment, these fixed income types of investment, are backed by either major corporations or backed by governments. And yes, governments can go bankrupt, but it's relatively low risk. Okay, so that's your fixed income. That's what we mean by that. Now, if we were to average out what do these types of investments over a 15, 20-year period, what type of interest rate do you get? Well, these ones, the fixed income, are generally between 3 and 3.5%. Okay, so that's the type of return you're going to get on your fixed income type of investment. So if we were to invest $100,000, okay, remember that's what we're talking about here, $100,000, and let's assume you're getting the high end of this at 3.5%. After 10 years, what is that money going to be worth? And what we're going to do is compare all of these different types of investment over a 10-year period, okay? And we'll see how the numbers actually work out. So 100,000, you get the 3.5% every single year for 10 years. It compounds as it goes. At the end of 10 years, how much money do you have? Remember, we are 100K in. At the end of 10 years, we are at $141,059. Okay. So you're saying, I put in 100 grand, relatively low risk. At the end of 10 years, I should have roughly about $141,000. That's what your return on investment is. Now, because it compounds, remember we're working on 3.5%, because it compounds, you actually get a little bit more than that. You're averaging roughly a 41% ROI. 41% ROI over the 10 years, which works out to 4.1% on average per year. Okay, so hopefully that makes sense so far, and hopefully you're following me. If anyone's getting lost, just let me know, but hopefully this makes sense. That's the fixed income investment, and that's roughly how the numbers are going to work out over a 10-year period. Now let's move on. Now, one of the first investments that I remember getting when Tiffany and I first got married is we put a little bit of money into a mutual fund, and we were sitting down with somebody at the bank, and the bank representative said, here's the options that you have. What do you want to invest in? Okay, has anybody ever been in that position before? And you're looking at all of these different names of mutual funds and index funds and all of these kinds of things, and you really are just kind of pointing and choosing or taking somebody's recommendation. At least that was our experience when we first got started. So, but a lot of people invest in mutual funds. It's kind of a standard type of investment, I would say. So what's the risk level? Remember, we talked about the government bonds and that sort of thing being relatively low risk. Well, obviously mutual funds are slightly higher risk. What you're doing is you're pooling your money in with other investors, and you're combining all the investors' money in one particular fund. So, there is risk, because those companies that you're investing in, or those different funds that you're investing in, can go up certain years, they can go down certain years. So there is a little bit higher level of risk than the fixed income that we talked about. But your returns can be generally higher as well. Now, on those ones, the returns in the last 15 years in Canada, on average, have been between 6 and 7.5%. Okay, so mutual funds, in comparison, are roughly 6.5 to 7.5%. Sorry, 6.0 to 7.5%. That would be kind of a generalization. That's what those funds generally produce. Now, a lot of people are happy with that. A lot of people are actually thrilled if over a 10-year period, they actually got the 6 to 7.5%, somewhere in that range. Now, remember, there are fees that come off of that, as there are almost all of these types of investment that we're talking about. But that's what the average has shown to be. So how do the numbers work when we're talking this? Remember, we're putting the same amount of money in, 100K in. Now, at the end of 10 years, that's going to compound as the 10 years goes on as well. And at the end of 10 years, we're going to pick the 7.5% and use that as a number to be on the high side. You're going to end up with $206,000 and change. 206,000. So you just more than doubled your money. If you keep that 100,000 in a mutual fund, on average returns across Canada that, people have been getting over the number of years, you're going to slightly more than double your money. So that's a 106% ROI. Now, if you divide that by 10, you're roughly 10.6% per year. Okay. So we're just comparing apples to apples here. That's how the numbers work out when you're comparing a fixed income investment to a mutual fund. Remember, mutual funds have slightly higher risk, but they have, as you can see, slightly higher returns as well. Okay. Now, what's the next step? Have you ever invested in a stock? Who here has invested in stocks? If you've invested in stocks at some point, just say, I've invested in stocks, or yes, I have. I'm curious to know how many have actually put money into stocks. I've personally watched a lot of people invest in stocks. Tiffany and I have actually never invested in stocks, although I've been tempted many times, but we've actually never done it. But how do the numbers work on average when you're comparing stocks? Corey, do the math so fast. Well, we got to get through all of this because it's really, really exciting when we get to real estate, guys. Okay, and here's the thing, and actually I should have said this at the beginning. We're going back to the basics here when it comes to just figuring out ROIs, figuring out the numbers on these types of investments. And so, if you are somebody that's been with us for a couple of years, we've run through this stuff before, you know how to analyze real estate, you kind of know how the numbers work. Why is it good to go over this kind of information? Because if we want to scale our real estate business, we have to be able to simplify this information. We have to be able to explain it to somebody else who might be investing in mutual funds or stocks or bonds and say, hey, I have another option here, which is actually pretty cool, and you do much, much better. So if we can explain this type of stuff simply, easily, not only will it make more sense for us, we'll understand it better, but it will make more sense to the people that we're talking to. Okay, you can bring in partners to increase our real estate business. Okay, so that's why we're going over this. It's important whether we're new, this is the first time we're hearing it, or if we've heard this stuff a million times before. Okay, so we've compared fixed income to mutual funds so far. Okay, so I see a number of people. Yes, people have invested in stocks. Yes, Marie, some stocks do very well. Some stocks do horribly and disappear right off the stock market. I remember actually several years ago, there was a certain stock that Tiffany and I were watching, and we thought, if this is one that I would invest in, I would put money in this one. I believe in this one. I think the company is going to do really, really well based on the knowledge that we had at the time. About 2 years later, it wasn't even on the stock market anymore. So, you can do all the research you want when it comes to that kind of stuff, and you can either do really well, or your money can disappear. You can lose it. So let's compare apples to apples. Now let's talk stocks. Okay, so in a stock, it's a little bit higher risk, or definitely a significantly higher risk, because usually you're investing in one particular company, and that company, based upon people's opinions or based upon their earnings, based upon so many different factors, that stock can go up or that stock can go down, with or without your control at all. So stocks, what is the average return? This is the highest risk that we've been talking about out of these ones so far. What's the average returns? Well, if you invested in an index, okay, so an index stock, the TSX index, for example, that over from 1960 to 2018, okay, so that's a long period of time, 58 years, if I'm doing my math correctly, it's averaged a 9.3% return. So that's pretty good. That's taking a lot of the top stocks, putting them all together in an index fund. Your risk goes down lower. They've averaged about 9.3%. So let's say you're going to pick a good stock, you're going to do your research, and you're going to get 10% return on your stock, okay? And you're putting $100,000 in. Same thing as the other ones. Now, if you get 10% every single year, over the 10 years, some years it might be higher, some years it might be lower, but on average, you're going to average 10%. What are your returns going to be at the end of 10 years? Well, at the end of 10 years, your money is $259,374. That works out to a 159% ROI, or a 15.9% per year on average. Okay, so let's compare those three. Fixed income, super low risk, 4.1 per year. Mutual funds, higher risk, 10.6 per year. Stocks, even higher risk, but 15.9% per year return on average. These are average numbers, guys. Remember that. Some people are going to make more money on stocks. Some people are going to lose all their money on stocks. That can happen in mutual funds and everything else too. So just remember that these are averages that we're talking about. Okay, now, when we look at those numbers, which one would you invest in? Which one do you think you would invest in when you're comparing those three? What do you think? I'd like to see what the comments have to say about that. So let me know, would you invest in the fixed income, the mutual funds, or the stocks? A lot of the decision making comes down to what your tolerance level is for risk. Are you willing to risk your money to make a higher return? And that's really what's going to make the difference in that decision, isn't it? Now, how does real estate fit into this? Okay, what's the difference between real estate and some of these investments that we've been talking about? So here we go. We're going to compare the numbers for real estate. So and what we're talking about is not a personal residence or anything like that. We're talking about buying an investment property, okay? This is something that is an actual physical building, actual physical piece of land you're on title for. So this is actually relatively low risk. You can even insure your building. You can have insurance to cover you for damages to the building, weather damages, that sort of thing. You can't really buy insurance against the other types of investments that we've been talking about. So when you're talking about risk level, it is considered a low risk type of investment. And that's why people tend to steer towards real estate. Okay, so low risk, higher, even higher risk. But now we're going to real estate and we're back down to that low risk area. Now, as we've seen, the higher the risk, the higher the returns, right? Well, does that work for real estate? Can we have low risk and higher returns? Well, this is what we're going to look at. Now, what are the averages as far as real estate going up in value in Canada? Does anybody have a guess? If you were to say over the last 15 years, what has the national, now remember, not Toronto, not Vancouver, not Edmonton, what is the national average of real estate gone up over the last 15 years per year? What would your guess be as to what that number is? Throw it in the chat, guys. I want to see what your guesses are. What is the average increase in value over the last 15 years? What's your guess? I'm going to wait for some of these comments because I want to see what you think it is. So 15%, one person is saying 6. Sean and Andrea are saying 6. 20%, Julie is saying. So good guesses, guys. We have everything from 6%, another 6, another 5, 7. So all the way up to 23%, Chris is saying. So 23, Marion. So, okay, we're all over the place when it comes to these numbers. What is the average? In general, in Canada, the national sales average per year over the last 15 years is 6.1%. 6.1%. Okay, that's what it's gone up in value. Now, let's write that down. 6.1%. Now, when we're comparing these 4 types of investment, we can initially look at that and say, well, I'm getting 10% return on my stocks. Why would I invest in real estate? It's only going up 6%. You're going to see why in a second. But what we're going to do is actually run these numbers to be a little bit more on the conservative side. And by the way, guys, real estate in the COVID environment, year to year, from February to February, from February 2020 to February 2021, the national sales average price went up 13.5%. Can you believe that? 13.5% went up in the last year. So real estate is doing extremely well as far as going up in value in Canada right now. So keep that in mind. But we're not going to do our numbers based on 13.5%. What it's actually doing right now, we're going to do, and quite frankly, the predictions are saying that it's going to continue like that for at least the next year. Who knows what it's going to do after that? But here's the thing. We're going to do our numbers based on 5%, okay? 5%, because we want to be on the conservative side. Remember, we took the highest amount for every one of these, but we're going to take the lowest amount when it comes to analyzing our real estate. So let's mark this down to 5%, okay? But there's something about real estate that's a little different than every other investment out there. If we happen to have $100,000 and we're going to choose which one of these to invest it in, if we're going to choose which one, and we go towards real estate, we put $100,000 into a piece of real estate, we're not going to buy a property worth $100,000 because we only have to put 20% down. The bank is going to supply the other $400,000 because you only have to put 20% down in order to buy an investment property here in Canada. So the bank is going to supply us with another $400,000. Now here's a caveat. Yes, you have to be able to qualify for a mortgage in this scenario, whereas the other ones you don't have to qualify for a mortgage. Okay, so there is a caveat there. But the bank is going to give you $400,000, and now you can buy a property worth $500,000 with your $100,000 of cash. Remember, you have the choice as to which one of these investments to put it in. Okay, so the beauty of this is that when this $500,000 goes up 5% per year for the next 10 years, you are making a return on the whole 500,000, even though you only put in 100,000. Okay, but you're making a return on that 500,000. You're making money off of the bank's money. You're using someone else's money to make money. That's the beautiful part about real estate, is you're leveraging your money. Okay, and you've heard us talk about this all the time, the power of leverage. It's super, super powerful. But now what happens when this 500K goes up in value at 5% on the conservative side over the next 10 years? What is it going to be valued at in 10 years? Well, if we quickly do the math, that property is valued at $814,000. $814,000. Not sure if you guys can hear that, but there's some work being done next door, I think. Okay, so it's gone up to 814. Guys, this is the biggest thing. On all of this is now you have made $314,000 on your 100K that you put in, and you still have your 100K. So that 100K turned into $414,000. Okay, let's just write this so it's the same as every other one. Okay, so we have 141, 206, 259. When we compare real estate, we're at 414,000, significantly higher, even though this is where people get confused. They get confused because real estate, they say, well, I'm getting 8% of my stocks and real estate only went up 4% last year. Or real estate only went up 5%. I'm just going to keep my money in the stocks. What they're missing out on is the power of that leverage and the power of having 500K in this scenario going up in value at 4 or 5%. Okay, so that is exactly where you're going to make money when it comes to real estate. But the cool part is it doesn't end there. There's other ways, as we all know, that we can make money in real estate. But let's just average this out here just so that it's all comparable. And I hope you guys are following this. You're now at a 314% ROI on average, 31.4% per year. Okay, so we're comparing 4, 10, 15, and 31%. We see how real estate compares to the other types of investment and really blows them out of the water. Remember, this is the low risk as well. This is something that can be backed by insurance. This is something that is a physical piece of property. So super, super When it comes to risk, now everything has risk. Don't get me wrong. There's always risks in what tenants can do to a property, although you can have insurance. There's risks in what weather can do to a property, although you can have insurance. There's risks that values can go down. But remember, we're talking over a 10-year period here, and we're being conservative in our numbers. Okay, but it doesn't end there. I told you there's more. So we're going to talk more about where you can make money in this. All right, so over that period of time, remember, you had a $400,000 mortgage. That $400,000 mortgage over a 10-year period, what's going to happen to it? Well, you're actually going to have your tenants are going to pay down another $95,000 on your mortgage. $95,000 mortgage pay down. Okay, so on top of it going up in value, on top of that conservative 5% that we're talking about, you're now having your tenants, because the tenants with their rent are paying the mortgage every single month. They're paying that mortgage down for you, and you get another $95,000, okay, in mortgage pay down. That is going to happen. You're going to get that mortgage pay down whether the market goes up or it goes sideways or goes down or does whatever it's going to do. Your tenants are paying your mortgage, assuming you have tenants in that property. Okay, but is that it? Well, there's another way, guys, that we make money in real estate, and that is through the cash flow. So if you are buying the proper property, you're doing the proper analysis, you are using our property analyzer to figure out your analysis when it comes to a property and figuring out whether it's a good property to buy or not. And if you aren't using it, go to investorlife.com/property analyzer, get a copy of it. Guys, you need to be analyzing your stuff properly. Why? Because if you have rent, your rent has to be higher than your expenses. So if you have $1 million property and you're making $100 a month in rent, that's not going to make sense, right? But if you have a $100,000 property and you're getting $1,000 a month in rent, that makes a ton of sense because you can cover your expenses. So this is why we always suggest doing the proper analysis beforehand. So let's again be super conservative. Let's assume that you're going to buy a property that cash flows $200 a month. Okay. Now, that's $200 a month the first year. Remember, every single year, typically, we raise rents. And at least over a 10-year period, you're going to significantly be raising those rents. I remember when we first bought our properties, some of the rents that we were getting in one particular place, we were getting $750 a month. That same place now rents for $1,500 a month. Do you think our cash flow has gone up? Dramatically. And that's even in Edmonton, even in Alberta's market. So our cash flow has significantly gone up on those properties. So over a 10-year period, is your rent going to increase? Absolutely. But let's assume, again, being super conservative, it's not going to go up at all. And you're going to get that $200 a month every single month for the next 10 years. You're not going to increase it and get 300 and 400 and 500 and 600, which you should be getting 6, 7, 8 years into the process. We're just going to do the numbers based on $200 a month per year. What does that work out to? $2,400 times 10 years is another $24,000 that you're collecting on a monthly basis when it comes to your real estate. Because why? You analyzed your property correctly. Okay, so now when we're figuring this out, remember we were at 414 here, but we're now adding another 95 and another 24,000. What is our total return, guys? Our total return is 513,000. Let me check my numbers. Nope, $533,000 that we're getting on this property, which works out to a 533% ROI and a 53.3% per year ROI. When we take into account our equity appreciation, when we take into account our mortgage pay down, and when we take into account the cash flow we're going to make on that property. And here's the caveats, guys. Yes, you have to qualify for a mortgage. What else? You also have to manage that property. take care of that investment. Whereas on a lot of these, maybe the stocks or the mutual funds, you can just put your money in there and leave it. Okay. So does it take a little bit more work for real estate investment? Yes, it does take a little bit more work. But when we see a 53% per year return versus a 4, which how many millions of people are out there getting this type of return on their money, or even this type of return on their money, and they're thinking that it's absolutely amazing, the returns that they're getting. We compare that to real estate, guys, and there's absolutely no comparison. So why do they say that all millionaires, or whatever the percentage is, 90% of millionaires are made by real estate? It's because of this, guys. Why do people look at real estate investing as the way to get out of the rat race, the way to get out of the grind? It's because of this, guys. And so this is the benefit to real estate investment. And this is why we wanted to go over this today. It's super, super important that we talk about this and that you understand this, and that this is super, super clear, because you need to be able to explain this in a simple manner to potential GV partners. If you want people to invest with you, then you need to be able to tell them why they're wasting their time in these other investments and why they should be looking to invest in real estate. Now, here's the caveat in all of this that is actually really good when it comes to real estate. In this scenario, you don't even need the $100,000. In these 3 scenarios, you need to have the $100,000 in order to do what we were talking about doing. But in the real estate scenario, you don't have to have the $100,000, because somebody else, a potential financial partner, can invest their money. That's the key to all this, guys, is that you can use somebody else's money for the $100,000 down. You're using the bank's money for the $400,000 in that particular investment. You can use somebody else, a financial partner, to invest with you if you're going to do the work, and you're going to get these kind of returns. And then if you're putting nothing in, you know what your ROI is in that scenario? Your ROI is ridiculously infinite, because you're not putting any money in. What's the ROI for the financial partner? Divide this by 2. They're still getting 26 point something percent return on their money on a yearly basis. And then they don't have to do any of the work. So in this scenario, it's 26%. What are their other options? Super low risk versus high risk, better returns, lower returns. Guys, it's a no-brainer for people to be investing in real estate as a financial partner if they don't want to do the work. It's a no-brainer for people to be investing in real estate as a working partner and not have to put in the money. That's where these partnerships come, and that's where you can do ridiculously well in real estate investment. Okay, guys, I want you to tell me if this is making sense, what you think about this. Is this explanation going through this, is this going to make sense? If you can explain this, use these numbers to somebody, a potential partner, show them why they're wasting their time in these other investments, and just not, like, what's the point, really, when you have this as an option? It just makes so much more sense. Okay, guys, so that's what we wanted to go through today. I'm not sure if we have any questions. I haven't seen any, but Tiff, if there are any questions, maybe throw them up on the screen and we can deal with that. But I haven't seen any questions as we've been going through this.
I don't believe so.
Okay, awesome. Tiff says no questions. Guys, if you do, you're wondering how do these numbers work or something like that, remember this video stays in Fearless. It stays in Fearless for the next week, and it's actually on YouTube as well. You can always access it there if you want to listen to it again, or if you want to share it. You know, if you want me to explain this to somebody, instead of you having to explain this to somebody, share the video. They're going to get it. They're going to understand the difference, because a lot of people get stuck on this number up here, guys, and that's why they ignore real estate, is because they get stuck on all the news headlines that we hear about real estate going up, going down, all that kind of stuff.
Step just a little bit that way.
Step this way. Okay, we're into the middle. Okay, I see that, Marie. I'll step in the middle. Okay, so that's it, guys. That's our training for this week, is the difference, comparing these different types of investment, from your fixed income to your mutual funds to your stocks to real estate. And we just want to make that super clear. not only for you if this is the first time you're hearing this, because I know we have a lot of newbies that are just getting into this arena and they're wanting to learn why everybody's so excited about real estate investment, but also for you guys that have been around a long time, so you can explain this clearly, explain it simply. And when you're explaining these numbers, guys, use round numbers like $100,000. Use easy numbers like 10 years. Obviously, if this continued on to 20 years or 25 years and you're showing the numbers, real estate actually outperforms everything even that much more, because that mortgage completely disappears. The cash flow goes up dramatically. And there's so many other options that you have. So, but when you're explaining these kind of things, make sure you pick round numbers, easy to understand numbers. Don't make it more complicated than you have to. And partners are gonna figure it out. People that you're talking to and you're starting conversations with, they're gonna figure out, this person, they know what they're talking about. They understand the concept of real estate investing, and that's what we want you guys to understand, is the concept of real estate investing and why it is so much more powerful than virtually every other type of investment out there. Okay, so were there any questions, Tiff? No, that's it. So that is our training for this week, guys. So thank you for joining us. And we have a really cool April and May coming up when it comes to our Tactical Tuesdays. We're in the planning stages of putting together some really cool trainings. So we will see you next week as well. Thank you, Ray. Hopefully that was understandable to all of you. And it looks as though it was. We have no questions. So hopefully that means it was understandable. And we'll see you guys next week for another Tactical Tuesday. Oh, we got a question, Tiff says, just as I'm closing up. All right, no problem.
Which would you purchase?
Do you want to throw it on the screen?
Oh, sorry, yeah.
Okay.
Oh, no, sorry, that one.
Which would you purchase if you had 100,000? Put 20% down on one property or 20% down on a couple of properties? Good question. If you put it down on, so here's the way I would answer that question is, you're going to mitigate your risk slightly if you put it on more than one property. You're going to have more than one tenant. If you have one vacancy, then you're maybe 50% vacant instead of 100% vacant. So there's a little bit of an advantage in that way. But you now have maybe 2 roofs or 2 furnaces or 2 lawns or 2 tenants to deal with. So your amount of work that you're going to be doing also goes up. So, here's the key, guys, and this is something that's actually super important. And Debbie, I'm glad you brought this up, because when we are looking at real estate investment, a lot of people quote, and we quote all the time, yeah, we bought over 100 properties here in the Edmonton area. And we talk about how many properties we own or how many doors we have. To be honest with you, that is kind of irrelevant. What really matters is the amount or the value of real estate that you have or that you own that's going up in value. That is the important key, is how much value in real estate do you have that can take advantage of going up that 5%. Okay, so if I have 500,000 going up at 5%, or if I have $1 million going up at 5%, which is better, obviously the $1 million going up at 5%. So don't get stuck on whether you have 2 doors that are worth $250,000 each, so that's a $500,000 value, or 1 door and that's a $500,000 value. There's little intricacies in there as to, you now have double the things to take care of and double the tenants to take care of. You do mitigate a little bit of your risk, but just focus, guys, on the value of real estate that you own. That is the important part to focus on. Hopefully that answered your question.
I think we're all going to have to follow Ryan.
Ryan, yeah, all those numbers need beer. Well, you know what? I might join you a little bit later on, Ryan. Yeah, we'll see. We'll see. Maybe a glass of wine, something like that. Okay, good, guys. That's it for today. Thank you for all your questions. Thank you for your comments. Thank you for, I see all of the thank yous on there, and everybody seems to say this was simple and it made sense. That's what I was hoping for. So explain this, guys, and practice explaining it to others. The more you get this out there, the easier it's going to be able to explain to others when you're talking to them and lock down some of those partners. Okay, guys, take care. Thanks for joining us for our Tactical Tuesday, and we'll see you next week.